you everybody for joining in on today's live stream. Had a little trouble getting it started. I wasn't sure why. Let me make sure the Wi-Fi is off. Wi-Fi is pain number 2. I'll get rid of the Bluetooth so it don't accidentally connect to nothing. Okay, now we're live. Thank you everybody for joining in on today's live stream, where we will be talking about how they deliberately confuse the people, and that is part of their monetary policy, how it is that they conduct themselves, and I'm going to show you evidence of that through their own words, through their own speeches given by Phillips Jefferson, talking about the communication and how they deliberately do this. They do this on purpose because it makes for better policy. Now, what it means to deliberately do this is really well kind of given, how am I saying this? Is well, let me just back it up, take a sip of coffee. Let me try speaking again since I don't seem to know how to do that. Okay, this article well describes, there we go, how it is that they do this. They are confusing on purpose. Now, down in the description, I have left a link to an article. I've never heard of this. Scotsman Guide. I don't know. Scotsman Guide, right? I don't know. I've never heard of this publication, but I like the article itself. It's titled, Fed Officials Offer Differing Signals on Timing of Potential Interest Rate Cuts. Now, this is something that we have not only talked about, but also have internalized to know that they do this on purpose to create an open-ended discussion. Like you have no idea what it is that they plan on doing into the future. The article kind of reads like this. It goes, Federal Reserve officials offered differing takes this week on when the central bank might move to cut the benchmark federal funds rate from its current range of 4.25 to 4.5%. Beth Hammack, the president and CEO of the Federal Reserve Bank of Cleveland, who serves as an alternate member of the Federal Open Market Committee, so she's part of the FOMC, that sets U.S. monetary policy, said during a CNBC interview this week that she's doubtful the Fed will make any interest rate changes at its May 7th meeting. She did, however, signal at June rate move a possibility. So as it continues on to talk about this, the governors like Christopher Waller, this President Beth, there's Michelle Bowman, all these different Fed officials come out and they all give their opinions and they all start to differ from one another. Not necessarily 100% differ, some of them align with each other, but nobody knows exactly what it is that's taking place out there due to the fact that you have so many different Fed officials who are coming out and talking about it. The article comes on like this. Federal Reserve Governor Christopher Waller, a current FOMC member, said during a Bloomberg television interview on Thursday that he would support a rate cut if Trump administration tariff policies result in significant increase in unemployment. Now, I think that's probably one of the key to it, is to understand that the Federal Reserve is mandated to do two things. Low inflation with stable prices, somewhere around a 2% inflation rate, right? That's always kind of relative. And then full employment or maximum employment, there's a couple of ways that they refer to it as, but ultimately keeping the employment or the labor market in a good term or in a good standing. So if the unemployment starts to rise or the labor market starts to deteriorate, this is one of their mandates to actually do something about it. And many of the Fed officials will say it. We're keeping an eye on the labor market. Inflation is coming down to the 2% goal, which is, a 2% average inflation rate over time. But more importantly, they're keeping an eye on that labor market. Goes on to say, but Waller said he doesn't think that impacts of tariffs will result in enough happening in the real data in the next couple of months until you get past July, at which point the Fed may need to cut rates. I'm not going to overreact. This is a quote. I'm not going to overreact to any increase in inflation that I think is attributed to the tariffs. But I see a significant drop in the labor market. But if I see a significant drop in the labor market, then then the employment side of the mandate, I think, is an important way to step in. Is important that we step in, Waller said. I would expect more rate cuts sooner once I start seeing some serious deterioration in the labor market. It's almost as if they expect it. I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market. So they're almost anticipating that. They like almost know that they are not going to be cutting rates until the labor market deteriorates. And many of these Fed officials are saying, hey, we see something happening towards the end of the year, the second half of the year. So at that point, there must be some sort of deterioration, or at least in their view, some sort of deterioration happening in the labor market, since every single one of them said it, or just about say it, that if there's a deterioration in the labor market, that will prompt us to cut rates. So this is kind of what I'm seeing is like, the Federal Reserve, at least in that sort of aspect, if they are going to be cutting rates, it's due to a deteriorating labor market, and they're saying that's going to be happening towards the end of the year. Not deteriorating labor market, but cutting of interest rates. So those two, if they align with each other, the cutting of interest rates must mean that there must be a deteriorating labor market at the end of the year, right? I don't know. Anyway, it goes on to say, Federal Reserve Chairman Jerome Powell played his cards close to the vest and didn't weigh in on the timing of potential rate cuts during the April 16th speech in Chicago. Since then, he was berated by President Donald Trump on social media on multiple occasions, including on April 17th post on Truth Social, in which the president declared that Powell's determination cannot come fast enough, right? And we did videos on this many times, and it was funny how quickly the news coverage evaporated from him talking about how much he would want to fire Jerome Powell to all of a sudden him saying, I didn't say that, that's not true, media runs away with stuff, and now there's like almost no talk about it. Like it just kind of turned to whispers. Anyway, moving on. Trump backtracked on Tuesday, telling reporters that he has no intentions to fire Powell. On Wednesday, though, Trump said he might call Powell to tell him to lower interest rates. It doesn't matter what you tell him. You can tell him anything you want. It doesn't matter. It doesn't mean they're going to listen. They don't have to listen. They never listened in the past. I don't know why they would think that, anybody would think that they're going to listen into the future. All right. And the article finishes off by saying, as of Friday afternoon, investors put those odds at 64% that the Fed will lower rates at its June 18th meeting, according to the CME FedWatch tool, which tracks Fed funds futures contracts. Tracks the Fed funds futures contracts. Investors are currently betting that the Fed will cut rates 3 or 4 times by the end of the year, beginning in June, according to the CME Group data. Now, I don't necessarily take those predictions or ideas that the Fed is going to be cutting rates, because I mean, I don't know how many times I've heard how it is that the Fed is going to be forced to do something, and here they've hardly cut rates at all. They've cut it 1 interest rate, 1 percentage point since the idea of peaking out with their Fed funds rate. Many people thought that they were going to be going to zero. That didn't even come remotely close to happening. In fact, once they started lowering the Fed funds rate, we saw things like mortgage rates moving up, quite opposite of what it is that people had anticipated. All right, so there's the article for the example. Now let's go and look at the evidence of how it is that they use their multiple statements coming from different directions in order to guide the markets into the direction in which that they want to see them go. And now we know that they use specific words and sentences in order to conduct themselves. We've seen that, we've read about that many times here over the speeches. But I want to break down this one particular section, and we've covered this just recently, and I think this is important to internalize, because considering that I was talking about it just a few weeks ago, and now here's evidence of it happening, right? So it's like the article is the evidence. I'm going to describe to you here how it works. All right, so now this is coming from the speech given May 13th, 2024, communicating about monetary policy, Philip Jefferson. And it says, surely, sometimes central bank communications can have unintended consequences. Let me give you 2 examples. First, there is always the risk that policymakers' statements about the economic outlook or their expected future path of the policy rate are interpreted by the public with a false sense of certainty. Now, this is important to understand. This is a problem for the Federal Reserve. Did you just hear it? That the public has a false sense of certainty. Like they're very certain about the outcome. Right? That's a problem for the Federal Reserve. I'm going to read the sentence again. Now listen for it. Surely, sometimes central bank communications can have unintended consequences. Let me give you two examples. First, there is always a risk that the policymakers' statements about the economy, their statements about the economy, and their economic outlook or their expected future path of the policy rate are interpreted by the public with a false sense of certainty. That becomes a problem because once the people are certain, now their words are no longer impactful. They got to keep them uncertain. Do you hear it in there? Again, I left a link down in the description. You can go read this for yourself. Now he goes on to describe how this works, right? This false sense of certainty. For example, a data-dependent forward guidance announcement can be mistaken for a commitment to a fixed path of interest rates. And this is how people really misinterpret what it is that the Federal Reserve has communicated. Misinterpretation is the key to this, right? If you misinterpret it, it's going to end up fouling and backfiring on you. Now, again, I'm going to read it. For example, a data-dependent forward guidance announcement can be mistaken for a commitment to a fixed path of interest rates. So when we heard at the end of 2024, or I'm sorry, at the end of 2023, that there was going to be 7 rate cuts throughout 2024. How many times did we hear that through the dot plot? There was all these like statements that they were going to go to 0, that there was going to be emergency rate cuts. There was all this talk and communication about a fixed path of policy, that they were committed themselves to this. Right? They committed themselves to this rate path, but they hadn't. It was the dot plot, which is a communication about how it is that the voting members of the FOMC are feeling about the current condition. If this was to continue, this is what we would expect interest rates to do. Nothing stays the same. The dot plot is really just a snapshot of what it is that they feel is taking place at this exact moment, but not a prediction of where interest rates are going to go. However, most people interpret it as an expectation of where interest rates are going to go, and that's not correct. That's an improper way of looking at it. So let me read it again. For example, a data-dependent forward guidance announcement, right, much like the dot plot, can be mistaken for a commitment to a fixed path of interest rates. It wasn't a commitment. It was basically an idea of what it is that the Federal Reserve was feeling at the time, but it was misinterpreted, right? When that interpretation is proven wrong down the road, it can create more volatility and uncertainty than if there had been no announcement. See, if they had not said anything at all, it would have created more volatility. I'm sorry. The idea that they had created this expectation through, or the misinterpretation, there we go. The misinterpretation that had been created from their statement that had been taken as a commitment when it wasn't, right? This is where the problem is, that when that interpretation is proven wrong, people look at them like, oh, the Fed had committed themselves to rate cuts and now they're backing up, right? But they never had committed themselves to a rate cut. But people are convinced that they were, and then when they back away from it, now it's the misinterpretation, right? When that interpretation is proven wrong down the road, it can create more volatility and uncertainty than if had there been no announcement. That is why policymakers always make sure to stress that they are, or that the, good Lord, I am having a hell of a time speaking today. Okay. That is why policymakers always make sure to stress that the data dependence of future policy decisions. And we have said that many times. They always keep it open-ended. They have never committed themselves to anything, because then they would end up giving up their ability to use their words to guide the markets. If the people are uncertain, have no clue about what it is that's taking place out there, then they can continue to talk about what it is that's going to happen into the future and guide the markets into the particular direction. If they end up going with a false sense of certainty and it doesn't go the way they want it to, it can create all kinds of volatility and uncertainty that is no longer controllable in a sense, right? Okay, that's why they keep it data dependent, right? Always. Second, it is also possible that the public misinterprets the views of individual policymakers as a committee view. Now, this is really where it starts to stand out. How many times have you heard a Fed official come out and give their point of view, and then people will then interpret that as a committee view, as the entire FOMC is thinking this particular way? It is very important to listen to each and every single one of the FOMC, the Federal Open Market Committee, the members individually to hear what it is that they have to say, because each one of them has a vote and they talk differently than each other, right? So again, second, it is possible that the public misinterprets the views of an individual policymakers as a committee view. The potential for misinterpretation is especially acute when many policymakers speak at the same time and disagree with each other. Now, again, right, we have to understand that they are trying to keep the expectation open-ended. If they create certainty within that, then they will lose their ability to use the forward guidance. Now, how do they do this, right? The potential for misinterpretation is especially acute when many policymakers speak at the same time and disagree with each other. Think about the article, right? Differing point of views. The article just came out. This speech came out months ago, right? Talking about how it is that they do this. Many of them come out and speak at the same time and disagree with each other. The diversity of viewpoints among policymakers lends itself to stimulating debates. Right? So we all start talking about this one said that, and that one said this, and this, and none, and none, and none. And they start having these debates on what it is that policy is going to do, right? This diversity of viewpoints among policymakers lends itself to stimulating debate and ultimately better policy. Right? Better policy by doing this. But in such a situation, more communication could increase rather than reduce uncertainty about our policy. So this is important to understand. By many of them coming out at the same time and differing, much like the article is describing, you have to recognize that this is part of the strategy that the Federal Reserve is deploying. We have evidence of it right here in this speech given back in May 13th of 2024, communicating about monetary policy given by Phillips Jefferson. And it says right in there, the potential for misinterpretation is especially acute when many policymakers speak at the same time and disagree with each other. The diversity of viewpoints among policymakers lends itself to stimulating debates and ultimately better policy. Right? This is more evidence of the credible threat theory. Once you see it, once you recognize, like I read that article and I'm like, that's exactly the strategy that the Federal Reserve said that they were planning on doing, was to have differing point of views coming out, because this is ultimately the way they make for better policy, is by keeping the people's misinterpretations of the policies as a committee view, right? Through all these different committee or all these different Fed officials coming out. And I know, again, like for a lot of people, they're probably still very confused by this whole idea on what it is that's taken place. But it must be understood that the Federal Reserve has lost the ability to conduct themselves with their interest rate adjustments in the fashion that they once had. Like everybody who understands the Federal Reserve throughout history knows that their primary tool was the adjustment of the Fed funds rate. However, after the great financial crisis, that came to an end, and their primary tool became their words. Forward guidance, signaling, job owning, and what I like to call credible threats. All right. Links are down in the description. All righty, let's read through some of these comments. I'm probably only going to be out here for like another 15, 20 minutes or so. We're going to keep this a fairly short one. Hey, John, howdy, howdy. We got, hey, Patrick, calling 8 on the dice. Thank you, All Nighter, for being here. We got Tom Flo, hello, y'all. Kurt says, hello, y'all. All Nighter says, hey, Tom. All Nighter says, hey, Kurt. Deja vu afternoon, y'all. Yui and what is that, the basketball? Is that what that is? Sunday, right on. Hey, Deja. We got Jesus, full employment can only come from federal government spending with a job guarantee. And deja vu, I see it as union bursting or busting. Hola. The only way to strengthen unions would be for government contracts having to be approved by the unions. That would make workers the money creators rather than corporations. A rate cut is really the least of our problems at this point. Confidence has been lost. Well, no, I don't agree with that. Confidence has not been lost, because if confidence was lost, then we would all be watching dollar bills flying through the street. And I guarantee you, if you threw your dollar bills out there in the street, there's going to be plenty of people who pick it up and go to the store and spend it. So it's not quite lost yet, right? People are losing confidence in it. But then again, if you think about it, since 1971 and the severing of the gold standard, nobody's really had confidence in the dollar. They're kind of forced into it, and they're forced to use it. And since there's really nothing else better than the dollar, they're going to accept it and use it. And I'm not trying to defend the dollar. I'm just trying to defend the fact that it's still taking place, that they have not lost it's not lost confidence yet. I mean, it's losing confidence, but it always has since 1971. The reason the economy is going down is because working people aren't making enough. They need to raise the minimum wage at the federal level and invest the young to be productive. Yeah, I think that's delusional thinking, Jesus. I mean, it will help, but I think it's ultimately no way to really actually fix the economy, because what we have is a high standard of living here, and what we can't do is produce something and sell it to the world being competitive against the rest of the world who produces that same sort of thing. Now, we produce a lot of really, really wonderful products. In fact, the United States produces some of the greatest products in the entire world. But that's also part of the problem, is that the things that we make are incredibly expensive, really nice, high quality things, and nobody else can really quite match some of those things that we are making, and that isn't enough. Right? We import way more than we export, and that's the problem. That's the bottom line. You can rearrange the situation all you want, but as long as we have a luxurious life with a high standard of living and we import more than we export, then we are going to have trade deficits that are going to continue into the future, that are going to separate the rich from the poor, because you have to have ever increasing amounts of debt issuance in order to maintain that. And as a world reserve currency, Triffin's dilemma does not allow us to do anything else except for import more stuff and export more dollars. That's the only direction it can go. Anything else would be painful experiences for everybody. And now I'm not saying I'm ready for it. Let's do it. Like, I'm not saying that we shouldn't do it. I think we should do it. Right? Like, I really do. I think, like, I'm ready to deal with the fact that there's going to be a painful experience that's going to come from it. I've thought about what it would be like. Ultimately, nobody else has, and they're going to be in so much pain and misery that they're going to beg the government to do anything but that. Right? I mean, nobody's going to do the right thing. The right thing, like, you can do the right thing on your own. Don't buy new cars. Don't buy anything luxurious. Don't spend your money on anything except for paying off debt. Once you're done with that, then you take all your money and you put it into production and savings, and you do that for the rest of your life. And then we do that for generations of people, and we might be able to reverse the situation, but there's nothing you can do, and there's no magic man who's going to come and reverse the situation. There isn't. It's not going to happen. So it's better to understand it in that way. That way you can really actually do something about it, because you can't change it. Like, that's the thing. You're not, like, people want to change the system. You can't. There's no changing this. The change is not coming in the way, and even if it was to change, it wouldn't be the way you want it. I guarantee you, it's not going to look the way you want it to. All right, keep hitting that like button, everybody. We're going to be out here for another few more minutes. Let's see if we can get it up to 100 likes. All right, yeah, nobody has thought this through as well as Simon has. I don't know if necessarily nobody has thought it through as well as I have, but when I think about the monetary policy and what it is that's coming from the Federal Reserve, I think that I have thought it through and through their strategy better than just about anybody else has, because I can't seem to find anybody else out there who's discussing the Fed strategy the way that I do it. And now, I'm not trying to brag it up saying that I'm the best in the world and nobody else got it and I do have it. What I am saying is that if I'm the only one who seems to be out here describing the Federal Reserve strategy the way that I do it, considering that I am pulling out their own words, Like, I'm not theorizing on what it is that's happening out there. I'm theorizing on their own words and their statements that they have made. All right. I mean, I want somebody to disprove it. I really do. I want somebody to go through all the different speeches, the member only videos that I have done, listen to them, read the speeches themselves, understand the credible threat theory, and then piece it together in a way that says, dude, I'm going to disprove it. I haven't found a single person who can do that yet. Not that anybody's actually going to take the time to learn the credible threat theory, but once you understand it, you don't see it any other way. It's just like, that's just the way it is. All right. The poor are getting angrier. Thomas, are you not so bright, are you? What does that mean? What are you guys talking about? Riots may be coming, but soon over monetary policy. I don't agree. Trump family motto: no smoking, no drinking, no gambling, no tattoos, no drugs. Believe in Trump. M Rider 777. Have you ever seen the movie Idiocracy? I feel reality in 10 times worse. At the point will the people break, or are we too dumb to realize the reality? The inequality is insane. I'm going up crazy. Yeah. I mean, I don't know if the clickbait titles of these videos are misleading. Yeah, beloved, because I said that I was going to do that for the last 30 days. I mean, I don't know why you keep stating the obvious on stuff like that, man. It's just like, I said I was going to do it. I said I was going to do it for 30 days. It was an experiment, not only to try and prove to myself that people will not care less about the content of the video. They will comment strictly off of the title, right? People will click strictly off of the title. They have, no expectations of actually learning anything from it. The only thing that the people really want is to be scared. Right? And that was the whole point of it. So I don't know why you keep bringing it up, right? You got a few more days of it. Get over it. Right? Don't mean to chew you out, but I'm just like, I'm tired of seeing it out there when I keep stating it over and over again for the last 3-4 weeks, right? Why it is that I've been doing that. So go ahead, say it again if you want. Why don't we just move on so we can actually talk about something real instead of the title of the video? All right. Long time, no join. How lumber inventories in the area? Well, thank you so much for the 10 Canadian dollars. Holy crap, did I get a big old super chat there? Where did that come from? Oh my gosh, okay, I'll go check that out in a second. Thank you so much. All right, how's lumber inventories in the area? To be honest, lumber inventory levels are pretty lean. Now, I'm not going to say that there is like shortages out there, but there's gaps in inventory, and there is, moments out there in which that there's a plentiful amount of one particular thing. Excuse me. Say like, for example, 2x12 eights, 8-footers, there might be loads of them, but then 2x12 16s, just double the length of it, and there's almost none out there. The price of it is almost twice the price. So there's big, huge fluctuations that are happening within the lumber market. The only thing that's going to bring any kind of stability to that is going to be increase in demand. Right now, we got low prices, but we also have lean inventory. So if there's any kind of spark to demand, what's going to end up happening is that it's going to end up depleting the inventory if the demand is high enough. Prices are going to move up, and the mills are going to ramp up production. So unless the demand is like off the charts, just a simple increase in demand, just an uptick. Every month it's getting a little bit more and a little bit more. This is going to increase the incentive for the mills to actually go out there and produce, especially if the prices move up. If the prices move up, they want to produce as much as possible. They don't want to be in curtailment. They want to be in production. I mean, you can't make money in curtailment, And so, it's a matter of time. And if the increase in demand starts to really be prevalent within the economy, and you start finding news articles on it, you can almost guarantee that and I'm talking home builder demand, right? That's coming from buyer sentiment. Buyer sentiment increases, home building demand will increase, lumber prices will start to move up after that. But until then, you can just expect that there's going to be lean inventory and lower prices for a while. Like that's the way it's been for some time, and I don't see things changing. Thank you for the $10. I really appreciate it, William G. Atheist number one. All right, ELS, thank you so much for the $49.99, man. That is so incredibly generous of you. Thank you. Do you think the Treasury bond market is weakening? You know, a lot of people say that it's weakening, but I don't think so. You know, there is the sense in which that when you see the yields rise, that's generally weakening bond, like, so yields work inversely to prices. So if bond prices go down, yields go up. If bond prices are going down, that's generally meaning that the investor is not wanting those, they are rejecting them, they're selling them, but the price of them going up, then the yield goes down, right? So prices go up, yields go down, prices go down, yields go up. All right, and we can break that down, how all that works too, because that's kind of complicated for a lot of people who don't understand how the bond market works. But a weakening bond market means that the bonds are either not being purchased or they're actually being sold out there. And with you have more of a market selling than buying, then what you will find is the prices, like supply and demand. You know, you have an increase in supply, low demand, then the prices come down. Those yields will start to rise. Now, if you go and you just look at, say, the Federal Reserve chart, like if you type in foreign holdings of U.S. debt, and then you type in the words FRED after that, right? What you're going to bring up is the Federal Reserve Bank of St. Louis, and they have just about every chart that you could ever possibly imagine to look at. And right now, if you typed in federal debt held by foreign and international investors, you look at that chart and there is, like, I mean, it has dropped slightly in Q3 of 2024. It was, what is this? This is probably in billions of dollars. What is this? So this is in billions of dollars. It was 8,678 billions of dollars and held by foreign and international investors. And then right now that number is 8,512. So there's been a small drop in how much holdings from Q3 to Q4 in 2024, and I'd imagine that it's probably dropped some since then. But you go back on that chart for like the last 10 years, or you max that chart out, and you're going to see that there is more holdings of U.S. Treasury debt by foreign and international investors right now than any time in history. Like, they're not getting out of it, they're getting into it. Now, there's another thing to think about when it comes to foreign and international investors holding U.S. Treasury debt. One of the reasons why they're holding so much of it is because so much has been issued, right? So with more issuance and the more possibility of foreign and international investors to hold it. Does that kind of make sense? So like if the government didn't go into as much debt as they have been, then they wouldn't have had the possibility to even own that much debt. But because the debt issuance has been so grand, right, there's been so much of it, the possibilities of the foreign and international investors to hold it or hold more of it has been presented. So now you see that that's exactly what has taken place. It doesn't mean that they're not getting out, right? There could be plenty of people who are getting out of the U.S. Treasury debt. The only issue that I push back against that is that when you sell U.S. Treasury debt, like this is the U.S. bonds, when a foreign entity, a foreign investor, they sell that Treasury bond, what do they receive in exchange for that Treasury bond? Cash, right? Now, unless they deploy that cash right away, what that does is it pulls cash out of the system. And when you start pulling cash out of the system, the demand for dollars starts to increase. Now, again, this is not necessarily talking about how it's going down right exactly now, but this is something that could be taking place, and it has taken place in the past. Many times when they get those dollars after they have sold the U.S. Treasury debt, once they have the dollars in possession, they pay their own dollar denominated debt. So they have taken out debts that are due in dollars. They need to pay those debts off, but they run out of dollars to pay the debt off. So they take their number one asset to cash, which is U.S. Treasury debt, sell that off, get the cash, and pay their own debts. Now, this is something that has taken place many times. If you go and read Dollar Funding Stresses in China, it describes it really well. That's another Federal Reserve document, and it's quite long. We did a cover, members only live stream, all right? We covered that particular document, talked about how it is that the U.S. dollar funding stresses in China developed by their own banks, their own corporations who have put themselves in that position. It wasn't the United States who did it. They did it to themselves. They wrote their own debts in dollars that are due in dollars, and getting those dollars, especially when you have problems like we are facing right now with international trades and tariffs and all the other stuff that's going on, how else are they going to get the dollars to pay their dollar denominated debt? Other than selling an asset that is the closest form to cash that you could ever possibly get without being cash, and that's a U.S. Treasury. Okay. And that's really what's happening, and what I believe is happening. All right, thank you so much, you guys. Don't kill me, I'm just a vibe. I love the name, $2. That's why the Feds are the buyers of last resort. Yeah, I mean, ultimately, the Federal Reserve is going to have to figure out something that they can purchase going into the future. Like the quantitative easing was an idea that was developed years and years before it happened. I mean, just go to, there's a speech given by Ben Bernanke. It's called Deflation and How to Prevent It from Ever Occurring here. And in that speech, he talks about how to cure deflation, right? And he talks about how the problem that they would face once they hit the lower bound of zero. So once the Fed funds rate hit zero, they would be like out of ammunition. And then he said, well, that's not a problem. We can still do other things. And now, outside of the job owning forward guidance, and then he describes it using a gold machine, he also talks about doing asset purchases, right? And so I'm going to read some of this just to kind of give you an idea on how this goes down, right? It says, I suspect that operating on rates on the long-term treasuries would provide sufficient leverage for the Fed to achieve its goals in the most plausible scenarios. If lowering yields on long-dated treasury securities provided insufficient to restart spending, however, the Fed might next consider an attempting to influence directly yields on privately issued securities. Isn't this interesting? Tried to influence directly the yields on privately issued securities. That's talking about like corporate debt, right? Unlike some central banks, in barring changes to current law, the Fed is relatively restricted in its ability to buy private securities directly. They can't do this. They can't buy corporate debt. However, the Fed does have a broad powers to lend to private sector indirectly via banks through the discount window. Right? So they lend banks a bunch of money through the discount window. Therefore, a secondary policy option complementary to operating in the markets for the Treasury and agency debt would be for the Fed to offer fixed-term loans to banks at low to zero interest. They're like, here, we'll loan you money for nothing, and you can go and lend that to the corporations. With a wide range of private assets, including, among others, corporate bonds, commercial paper, bank loans, and mortgages deemed eligible as collateral. So they're like, hey, if we're going to loan you money, you got to have something that we can use for collateral. Corporate bonds, right? Commercial paper, bank loans, and mortgages deemed eligible as collateral. For example, the Fed might make 90-day or 180-day zero interest rate loans to banks, take corporate commercial paper of the same maturity as collateral. Pursued aggressively, such a program could significantly reduce liquidity in terms of premiums in the assets used as collateral. Reductions in these premiums would lower the cost of capital both to banks and the non-bank private sector over and above the beneficial effect already conferred by lowering interest rates on government securities. So now I know that was really complicated, but we have to think about this. What he was describing there is essentially bailing out the entire system when the Federal Reserve had no longer the ability to lower interest rates. He was like, that's okay. If we can't lower interest rates, we have ways that we can get this money to those banks, to those corporations, to those financial institutions out there. Yeah. The Fed can inject money into the economy in still other ways. For example, the Fed has the authority to buy foreign government debt, as well as domestic government debt. Potentially, this class of asset offers a huge scope for the Fed operations, as the quantity of foreign assets eligible for purchase by the Federal Reserve is several times the stock of U.S. government debt. This has not happened yet, but it very well could going into the future, and Ben Bernanke described it in 2002. How long? Like, literally, this is November 21st, 2002. He described quantitative easing, and then when quantitative easing was no longer going to work for him anymore, because obviously we're sending the government on an unsustainable debt path by continuing the operations of quantitative easing, where the Fed loads up on U.S. Treasury debts. However, they have the legal authority already in place to buy foreign government debt. Right? For example, the Fed has the authority to buy foreign government debt as well as domestic government debt. Right? It's only a matter of time. They said, hey, if we run out of things to buy, if we're going to send the United States on an unsustainable debt path, there is always foreign government debt. So what does that look like when the Federal Reserve, who buys an asset, that being a foreign government treasury, essentially, and issues out a liability? Well, the Fed's liability are U.S. dollars, bank reserves. So our money is being backed by that of a foreign asset? Is that what the Federal Reserve is describing here? I mean, this is pretty wild to think about. All right, let's see here. All right, inflation has always been a thing, but until recently, wages kept up with it. It would be different if everyone was making $45 an hour, but they blow up stock and real estate bubbles with QE while wages lag. Dissident, I understand your frustration, but here's the problem with it is that by even believing the inflationary scenario, you are actually being a benefit to the Federal Reserve. Now, this is something that was coming from Jerome Powell, and I know it's hard to internalize, and it's sad. It's sad what they are doing to us, because I'm going to read this to you. This is coming from Jerome Powell, August 27th of 2020. This is before inflationary scenario. This is before it happened. Remember, this is like just getting started. COVID is just ramping up, right? But inflation hasn't taken place yet. The persistent undershoot of inflation from our 2% long-run objective is a cause for concern. This is Jerome Powell saying this. The persistent undershoot of inflation from our 2% long-run objective is a cause for concern. We have to internalize it. The Federal Reserve was going, oh, what do? We do not have inflation. We are failing to find the inflationary scenario. It's a cause for concern. We better do something about it. What is it they're going to do? Many find it counterintuitive that the Fed would want to push up inflation. Well, no kidding, you would want, since you seem to not be able to find inflation, I find it counterintuitive that you would be able to even do it in the first place. But yet many people find it counterintuitive that the Fed would want to push up inflation. After all, low and stable inflation is essential for a well-functioning economy. And we are certainly mindful that higher prices for essential items such as food, gasoline, and shelter add to the burdens faced by many families, especially those struggling with lost jobs and incomes. They know it's painful. It's a painful experience. Those, mindful of the higher prices for essential items such as food, gasoline, and shelter add to the burdens faced by many families. Right? They know it's a burden on you. They knew it. They knew it was going to be because it hadn't happened yet, but they knew it was going to be this painful experience. Right? And they said it, especially for those struggling with lost jobs and incomes. However, we know this is a painful thing. We tried to get inflation, couldn't do it. But however, inflation that is persistently too low can pose a serious risk to the economy. However, your painful experience is the way we're going to solve the risk to the economy. However, inflation that is persistently too low, right? Can't have inflation too high, right? That'd be a bad thing. No. The inflation that is persistently too low can pose a serious risk to the economy. Inflation that runs below its desired level can lead to an unwelcome fall in long-term inflation expectations, which in turn can pull actual inflation even lower, resulting in an adverse cycle of ever lower inflation and inflation expectations. So here, the Federal Reserve, Jerome Powell, through his own words, August 27th of 2020, prior to COVID, prior to the inflation, was saying, many people will find it counterintuitive that we would want to push up inflation, but considering that the quantitative easing of 1, 2, 3, and 4 failed to produce the inflationary scenario that we are looking for, we're really going to have to push this idea of an inflation expectation out there in order to achieve the monetary policy because it was interfering with them. It was posing a serious risk. This is Jerome Powell saying it. Too low of inflation posed a serious risk. However, inflation that is persistently too low can pose a serious risk to the economy. That's his words, not mine. See, elevated inflation expectation doesn't pose a serious risk to the economy. Too low of inflation expectation does. So if you have elevated inflation expectation, congratulations, you are helping the Federal Reserve win. Right? I mean, he said it right there. However, inflation that is persistently too low can pose a serious risk to the economy. So if you have inflation that is running persistently too high, that's not posing a serious risk to the economy. Too low of inflation is. I got to repeat it over and over again because everybody who falls into the inflation is killing me scenario and thoughts, I understand it's painful. He said it was going to be painful. But we also have to understand that they did this on purpose in order to save themselves. Why? Why did they do it to save themselves? If we don't understand it, then we will not understand their next move. Goes on, this dynamic is a problem because expected inflation feeds directly into the general level of interest rates. While anchored inflation expectations are critical for giving the Fed the latitude to support employment when necessary without destabilizing inflation. But if inflation expectations fall below the 2% objective, interest rates would decline in tandem. In turn, we would have less scope to cut interest rates to boost employment during economic downturns. That's what he is describing. You hit the lower bound of zero, there is no more room. You can't stimulate the economy by dropping interest rates. They're screwed. They have no scope. All right, that's what he's saying. In turn, we would have less scope to cut interest rates to boost employment during the economic downturns, further diminishing the capacity to stabilize the economy through cutting of interest rates. It wouldn't work for him. Further diminishing the capacity to stabilize the economy through the cutting of interest rates. You see how the problem? They were desperate. They were so desperate for inflation back in 2020. Like desperately trying to find it. We have seen this adverse dynamic play out in other major economies around the world and have learned that once it sets in, it can be very difficult to overcome. We want to do what we can to prevent such a dynamic from happening here. So here it is, 20 years earlier, right? Actually, 18 years earlier, Ben Bernanke was given a speech talking about deflation and how to prevent it from ever occurring. And here it is 20 years later, they're giving speeches talking about how how a too low of inflation expectation is the problem that they need to solve. It's still continuing 20 years later. Nobody knows it, right? Nobody knows that this is their major problem. But if you read through their speeches and you start to understand how it is their problem, then it starts to make a lot more sense on what it is that they are doing out here. Yeah, I'll read a little bit more to you guys. Let me see. I think this is probably one of the most important parts of this speech right here. I'm going to read it. I've read it a million times, but I think you guys like it anyway. We have also made important changes with regard to the stability side of our mandate. Our long-run goal continues to be inflation rate of 2%. So think about this, the long-run goal. That means over time. The long-run goal is a 2% inflation. Our statement emphasizes that our actions to achieve both sides of our dual mandate will be most effective if long-term inflation expectations remained well anchored at 2%. So they have to repeat it over again. 2%, 2%. Our goal is 2%. Our 2% objective, a 2% goal, 2%, 2%. But it's the long-term inflation expectations that they want well anchored at 2%. However, again with the word however and Jerome Powell, however, if inflation runs below 2% following economic downturns but never moves above 2%, even when the economy is strong, then over time inflation will average less than 2%. Households and businesses will come to expect this result, meaning that inflation expectations would tend to move below our inflation goal and pull realized inflation down. To prevent this outcome, a bad deal. Can't have inflation too low. Bad idea. To prevent this outcome and the adverse dynamics that could ensue, our new statement indicates that we will seek to achieve inflation that averages 2% over time. Therefore, following periods when inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. Okay? Moderately above 2% for some time. In seeking to achieve inflation that averages 2% over time, we are not tying ourselves to a particular mathematical formula that defines the average. Isn't that convenient for them? No mathematical formula for figuring out the average. Thus, our approach could be viewed as a flexible form of average inflation targeting. Our decision about appropriate monetary policy will likely continue to reflect a broad array of considerations and will not be dictated by any formula. Of course, if excessive inflationary pressures were to build or inflation expectations were to ratchet above levels consistent with our goal, we would not hesitate to act. See how this works? They want you to have elevated inflation expectation because it works for their monetary policy. They needed you to have it. If you didn't have it, it would have failed. All right, Jeff Welch. I'm going to have to quit here before too long, guys. I'll give it another 8 minutes. One thing I have learned from watching UE is not to stress over economics anymore. I'm responsible for my own economy. Jeff Welch, thank you so much for the $4.99, and I absolutely appreciate that because that's exactly what it is. Right? We are responsible for ourselves. We are responsible for every decision that we have made. We are responsible for the outcome that came from that. There is nothing that anybody can ever possibly do to come and benefit your life like you can benefit for your life. Right? There's nobody out there. There's really nobody that can ever possibly do it anyway. Right? Even if they said that they could, they can't. So it's most important to understand that you need to make the most and best appropriate decisions for yourself, and a lot of that is not relying on somebody else to make the right decision. To not create an environment that is appropriate for you. It's for you to look at the environment and make the appropriate decision for yourself. Right? I mean, it's just like anything else out there. If you rely on somebody else to get you into the position that you are in, then you're going to have to rely on them to tell you when to get out. But if you are making that all on your own, you don't rely on anybody else for your decision making. And again, I leave these links down in the description for you guys. Like I didn't leave the last two speeches, but I've told you exactly where to go get them and how to find them. August 27th of 2020, New Economic Challenges and the Fed's Monetary Policy Review given by Jerome H. Powell. Right? This is his own words talking about what it is that they were going to do to the people, and they were going to inflict pain and suffering upon them. However, if they didn't, it would create some really bad situations for monetary policy. How did he say it? Well, I'll tell you exactly how he said it. However, inflation that is persistently too low can pose serious risks to the economy. This is how they do it, guys. Yeah. All right. High inflation pulls more of those Fed notes out of circulation. I mean, ultimately, this is so that they raise the neutral interest rate. If they can raise the neutral interest rate, then they'll have more scope, right? They'll have more scope, which is the actual stimulating effect of dropping interest rates far enough below neutral to actually stimulate the economy, right? I'm the only one who's describing it this way because nobody else is reading these speeches like I do, I guess, except for the Federal Reserve. Like, they're the only ones, the only other people who I can find talking like this. But they don't talk about it on the mainstream media. You're never going to, like, nothing inside of the articles. The closest thing that I can find where they talk about anything similar to what is going on in their speeches is when they talk about the strength or weakness in the labor market being the indication of where they're going to go with interest rates. Everything else is market perception of their words. If the labor market deteriorates over time and you start seeing unemployment rise, they will act. And they were acting preemptively when it came to the interest rate cuts that they did last year in 2024. They were wanting to maintain the strength of the labor market. That's what a lot of their own words were inside of the statements when they asked, why did you cut rates so much in the first interest rate cut? Yeah, and that was it. Like, if you want to know what they're going to do with interest rates, watch the unemployment. If unemployment rises, then they'll cut rates, guaranteed. Like, they're mandated, right? But everything else is market perception. They are not mandated to make sure that the stock market stays elevated, or that the housing market stays elevated, or that anything else like that. Right? Low inflation with stable prices of somewhere around 2% inflation, right? And full employment. That's it. Everything else is like, somebody else's misinterpretation of their mandate. Simon is his own man. I don't get him to do anything. All nighter, use your mod power to message and text him so you get your answer. All nighter. All right. I think Simon understands housing has several supply and demand metrics, the need for shelter and the need for monetary premium and shelter from inflation. Simon, what are your views on home prices and residential real estate market, and does it keep going up? I mean, it does. It comes down to supply and demand issues that is based on the fact that we have very little going into production. I mean, you think about it, if you have a gap in production, at the same time you're having pent up demand, like, what could that ever possibly do to prices? Did that seem like an environment that's going to, like, lower prices going into the future when you're not building as many? There's less starts, like, you have a drop in starts. And then every day you're finding where there's less homes being sold. Well, if there's less homes being sold, that's another person moving to the sideline wishing that they would buy a home, but they don't want to do it right now. So there's buyers on the sidelines just waiting for better opportunity. So you see, like, I mean, what could possibly happen? Like, the moment that the prices start to go down, you have people who have been postponing purchases waiting for that opportunity. Just saying, all right? Like, I mean, that alone. And I understand that people say, well, they won't be able to afford it. Yeah, well, people are paying cash now for houses, and they don't care what the interest rates are, and they're okay with these prices. Again, and it's like more cash buyers now than since like the early 80s. Real estate can reset with boomers aging out of low immigration rates also. Yeah, boomers aging out. I mean, I think about it. When you have like an older population that generally, I'm finding more and more of them are having like multi-generational households. So it may be like the boomer's house, but their kids or grandkids are living with them, taking care of them in their old age. And when they pass, those people are going to have a place to live. And if it's not in that house, it's going to be an apartment or something somewhere. So they're going to take away from somebody else's ability to rent or buy that house, right? I mean, if they aren't living in it, they're going to take an apartment away or something, right? So that's something that I don't hear a lot of people consider when they talk about the silver tsunami, is how many multi-generational households those boomers have. And then what's going to happen with those people when the boomer passes away? You know, they got to have a place to live. I'm going to give it one more comment here, guys, and then I'm going to go. All right, they are buying euro bonds. That does that do to, what does that do to our economy? Are we the euro dollar? No. Are you talking about talking about the Federal Reserve, if they buy, like, euro bonds or something? I don't know. It's all hypothetical, so it's really difficult to understand. I think it's probably going to end up happening more with the digital currency. Like, once you introduce like central bank digital currencies or stable coins, and then you can confine the currency to a particular region or location or purpose or use, then I think that would work a lot better and give it a lot more control. But again, like, this is like a very far off concept with, a whole lot of what ifs and hypotheticals involved with it. We have to stop representatives. We have mayors for that. All right. You guys are awesome. Thank you so much. I'm going to call it quits at an hour. We have $65 in super chats because you guys are so generous with those super chats. Thank you very much. 92 on the thumbs up. I was hoping we would get to 100, but we got to 92. That's not bad. 207 people watching right now. So thank you, everybody who has joined in on today's live stream, where we broke down what it is that the Federal Reserve is doing when they all come out at the exact same time with differing statements, knowing that is part of their strategy and how it is that they deploy that within their toolbox. We just described it within their own words from a speech given by Philip Jefferson, and shown examples of it within the links that are related to the articles that says that exact thing. Many different views coming from the Federal Reserve when it comes to interest rate cuts. Again, that's part of their policy. That's part of their tool. Alrighty, guys, you're awesome. Thank you so much for being here. Uneducated Economist. You guys let me know.